Well, joining me now to discuss that, Julian Callow, Chief European Economist for Barclays Capital right here in London. Thanks very much for joining us, Julian. Good to see you again. So, Will, I suppose a question that we've been asking for a while now, we're still asking whether or not this aid package is going to stem the threat of contagion.
Well, it clearly does quite a lot to diffuse the situation. I think when you see it, particularly in the context of the remarks that senior debt would not be in any way restructured as a consequence of the aid package as well, when we have the agreement you were discussing earlier on the collective action clauses in sovereign debt contracts from 2013. These two aspects, I think, of the discussions take out at least some of the degree of uncertainty that was really welling up in the market on Friday. At the same time, from what I can see, there's no particular reference here to Portugal or to Spain. So the implication is that these countries are in a somewhat different environment and not seem to be requiring assistance immediately. And therefore, the market attention, I think, is going to be very much on Portugal and Spain. But in general, as we're seeing already from the reaction of equity markets, we are seeing a degree of confidence returning, I think, globally, because let's face it, the package has been agreed. Ireland has accepted it. It's an important package. It's a very substantial package, and it does at least, I think, help to take care of the concerns that have been very significant related to Ireland and related to the Irish financial system here.
Will this degree of confidence in the markets that you mentioned last, given that attention is now turning to Spain and Portugal? You say they won't need immediate assistance, but further bailouts still to come?
Well, clearly Portugal is the country that is regarded by the financial markets as next in line here, really. I mean, Portugal has a very, very difficult task ahead. It's planning fiscal tightening, as you were saying earlier, of 4% of GDP in 2011. The economy is growing a little bit, but it's generally very soft, and that degree of fiscal tightening is likely to push Portugal back into recession. So there's going to be a lot of question marks, I think, about Portugal. Spain is in a somewhat better position in terms of its fiscal situation, but at the same time, there still is concern about the overall health of the Spanish banking sector, and in particular how vulnerable that could be to further significant falls in asset prices. So, I don't think we can say categorically here that either country is going to be forced into a bailout. But without doubt, there are some very large challenges ahead. And I don't think the market concern related to these countries is going to itself be dissipating that much, although, as I say, that there are some reasons for comfort here.
When we look at the actual economic fundamentals, are Spain and Portugal doing enough to show the markets that they are fixing their economies?
Well, the big problem you've got in monetary union for Ireland, for Spain and for Portugal is that they're attempting record amounts of fiscal consolidation at a time when the economy is very weak, and at a time when the economy actually ought to be having some kind of deflation in order to recover competitiveness against Germany, or at least to get unit labour costs deflating very sharply in relation to those of Germany. Now, just to get that deflation in the relative unit labour costs is a tall enough challenge anyway. But when you're doing that on top of substantial amounts of government borrowing, and you have to tighten there, and you have certainly for these three countries, particularly for Ireland and for Spain, you have significant ongoing falls in asset prices. Well, it's hard to make things really square up, and so that is why the market uncertainty is so prevalent with respect to Spain and Ireland, I think.
All right, thanks very much for putting all that into context for us, Julian Callow, their Chief European Economist at Barclays Capital. Now, we just